This is B207A. This is week 12. We are still in block 1. In block 1, we are discussing innovation. We started with defining innovation, then we moved to marketing. We also discussed operations management. We defined what operations management is and how we can implement innovation in operations management. Today, we will start a new topic with finance, raising finance. What does raising finance mean? What does this title mean to you? Do you know what this means? Yes, anybody has an idea what raising finance means? Let me give you a hint. Imagine you have a you have a small business. Let's say you have a coffee shop, and you want to expand your coffee shop, but you don't have money to expand your coffee shop. Okay, you need to find a source of finance, تمويل. All right, you need to find a source that helps you expand this business because you need money to expand the business. Okay, so what are you going to do in order to have this finance? What are your options?
Take a loan?
Absolutely, this is one answer. Yes, we can take a loan. So first of all, if you had the money, you will pay the money from yourself, right? So this would be called an owner equity finance. The owner himself will be financing the business. If you don't have the money, or if you don't want to use your own money, you can go to the bank and get a loan. Absolutely, this is another way. Any other ways? So here we want to be a little bit creative, innovative. Remember the block 1 title is innovation. We want to think about various ways and how we could expand this business. So if you, what is the third way of you finding the finance for the business?
From the capital?
The capital, if you are paying the capital, it will be an owner financed business, right? But you can find, let's say, someone that you know, an investor. Okay. What if you know someone who wants to invest in your business? That would be an investor, صح? ممول. Doesn't have to be the bank. It doesn't have to be you. You could have a partner. So this other person could finance your business. You could take their money, and what do you give them in return?
A part in equity?
Yes, absolutely. A part of equity, a part of the business. So later on, they will be entitled for a part of the profit that you make from your coffee shop, and so on. Okay, so this is the topic that we will discuss today. Raising finance means where we are going to get the money in order to finance the business. This is specifically for small and medium-sized organizations. Because big corporations have different ways, they have different numbers, but we will focus today on the small and medium size. المشاريع الصغيرة والميديوم. Okay, الحجم المتوسط والحجم الصغير organizations. So the major forms of finance, today we will discuss these points. 1, 2, 3, 4, 5, 6 points we have here that we are going to discuss. These are different ways that you could get money for your business to finance the business. Okay, so forms of finance يعني طرق التمويل. Financing through retained earnings. طيب, this word is very important, retained earnings. So any earning that you make in your coffee shop, you will save it. You will put it on the side. You will retain it, okay? You will not take it as the owner, okay? You're not gonna take any profits, but the earnings, you're gonna put them on the side, okay? For first month, second month, a year, 2 years, depending on how much money you need, okay? And then you are going to use this money to invest back in the business, okay? So this is the first way. Work, and from the profit you get from the business, you reinvest the money inside the business. Okay, is it clear, this idea? This is what retained earnings mean. Working capital comprises the resources organizations have at their disposal as a result of the day-to-day running of the business. So in your business, you are going to earn money from your customers, and you are going to pay money to who? Who do you pay money to?
To the supplier?
Yes, absolutely. To the supplier and to the employees. So hopefully the difference will be positive because you want to make a profit. So hopefully you want to have this positive difference between what you pay and what you earn in order to make the retained earnings. Okay, now, however, there's also a way, so if you are an accountant, if you are doing an accounting major or if you have taken an accounting course before, then you know what receivables are and what payables are. Okay, type. I will explain it very briefly. Receivables are amounts of money that will be received in the future from your customers. طيب, يعني suppose this doesn't really apply to a coffee shop. This applies to businesses where payment is delayed. Okay, يعني مثلا actually yes, I will apply this on the coffee shop. طيب, imagine the coffee shop has a supplier from which it buys the coffee. Okay, so you have a supplier called X, and your coffee shop buys the coffee from this supplier. In this case, who is the customer and who is the supplier?
The customer is coffee shop.
Yes, the customer is the coffee shop. Okay, so the customer, which is you go to your supplier and you say, I want to buy coffee from you in bulk. Okay, big quantities of coffee. But you know what, my dear supplier? I don't have money to pay you now. I can pay you once I sell the coffee. Okay? This happens a lot in business-to-business transactions. So you are going to delay your payment till after you sell or to a certain date that you both agree on. Okay? So the coffee shop owner, which is the customer, takes the coffee in a business transaction, okay, but doesn't pay the amount to the supplier. All right, so in this case, the supplier has receivables. This is what receivables mean. This is the amount of money to be received in the future, but it should be received because the transaction خلاص is done. يعني the customer already took البضاعة. Okay, the customer already took the product, so the transaction is done. يعني it's not a kind of forecast. هي مش forecast، مش أنا بتوقع بالمستقبل بدي بيع. No, أنا بعت, I sold the product, but still I didn't get the payment. Okay, so what is the opposite of receivables? It's the payables. Payables is on the customer side. It's something that the customer has to pay in the near future. Okay, so receivable is something that the business will earn, so will receive, but it's already earned. Okay, the payable is something, is an amount of money that the business will have to pay. So it's exactly the opposite. So on the balance sheet of the customer, okay, this amount is mentioned under payable. But on the balance sheet of the supplier, this amount is mentioned as a receivable. Okay, is this idea clear? The difference between receivables and payables. Is it clear? Okay. Why are we explaining this as form of finance? Okay, because the coffee owner, instead of going to the bank and borrowing money from the bank to buy the coffee, okay, the coffee owner is borrowing money from the supplier. Okay, in this case, we are borrowing the money in the form of payable. Okay, and we're not borrowing money from investors or the bank, or we are not using our own money. Actually, we are using the money of the supplier. And this is what retained earnings mean. You will see many businesses do this activity. They use their suppliers' products, okay, to finance their business. And the supplier wants to do business. They want extra business. So they accept this, of course, based on some terms, based on a certain contract that the customer, which is the coffee shop, the customer will be paying this amount of money in the near future. Okay, so many small businesses have limited working capital. In many cases, the small businesses don't have a lot of money. So they have to use these ways in order to grow their businesses. Organizations may also manage their cash flows with the intention of using them to provide liquidity by operating with negative working capital. Okay, this is what negative working capital means. It's where the amounts due to creditors or trade payables exceed those due to be received from customers. So it means that what I have borrowed from my suppliers, okay, so the amount of money that I have borrowed from my suppliers is more than what I have lent to my customers. Okay, يعني الأماونتس اللي أنا تدينت من السبلايرز هي أكثر من الأماونتس اللي أنا دينتها للكاستمرز تاعوني. أوكي، طيب شو بيصير لما أنا بتدين أكثر ما بدين؟ شو بيصير؟ So I'm borrowing more than what I'm lending. What happens? When I borrow more, okay, I will have what we call negative working capital. لأن الفلوس اللي عندي هلا عم استعملها as working capital هي بالنيجاتيف، هي بالسالب. It's not my money. It's somebody else's money. This is why we call it negative working capital, because it's whatever I'm borrowing is more than what I'm lending. Okay? Now, here we have an example of working capital. Would a water company or a car manufacturer be better placed to use working capital management to finance their business? Consider why. So in order to answer this question, we have to understand the nature of business that each one of these two businesses have. Okay, so a water company, it receives payments from their customers at the start of every half year. So this is what they're saying here. Probably this is how it is in the UK where this book was written. Okay, or on a monthly basis. So this service is prepaid. Okay, the service is prepaid, which means that you are getting the money from your customers ahead of time. Yani just like what you do with Netflix or with any subscription service, you pay and then you use the service. Okay, so the money that the business gets from their customers is more than the money that they borrow from the supplier. Okay, in this case, the negative working capital does not apply. In the case of the water, why it doesn't apply? Because you will always have a positive working capital. Always you are getting the money first from the customer, not later. Okay? Now, by contrast, those buying a new car only pay the full amount on its delivery. So a car manufacturer, okay, مصنع السيارات, definitely will borrow from the suppliers. Okay, will definitely borrow money from the suppliers of leather, from the suppliers of يعني كل قطع السيارات اللي بحطوها جوا السيارة كل واحدة منهم عندها supplier. Okay, so the car manufacturer can use these suppliers as a form of finance to their business. يعني هن ممكن يركبوا السيارة ولسه ما دافعين ولا يعني سعر ولا قطعة منها. Okay, once they sell it to the customer بيسكروا الدين عند the supplier. Okay, in this case we call this negative working capital. Okay, so يعني حتى نفهم شو يعني working capital, we need to understand the difference between how these two businesses operate. Okay, so not in every business this is applicable. In some businesses this could not be applicable. Okay, here we have another example. Tesco, for example. Tesco is a supermarket in the UK. We have the Tesco balance sheet. Okay, it's not available here. We need to open it. I don't have access to it, actually. So let me just skip this part. It's okay, because we need the balance sheet in order to look at this example. So let me just skip it for now. So as we said, the first form of finance is called the working capital. Okay, now the second is called debt factoring. And this is an interesting way of financing your business. What does the word debt mean? حدا بيعرف شو يعني debt؟
دين.
الدين, exactly. Debt factoring يعني لما الشركات بتبيع الدين تبعها. اوكي, في حدا بيبيع الدين؟ سمعتوا قبل انه شركة مثلا ممكن تبيع الدين اللي عندها؟ يعني مش الدين اللي هي مدينة له، الدين اللي الأماونتس اللي بدها إياهم من الكاستمرز. This is what debt factoring means. Okay, so this takes us back to the concept of receivables. Okay, the word receivable means that these amounts I still have to collect from my customers, correct? So these amounts, the receivables will be collected from the customer. But you know what? I don't have the time and money and energy to follow my customers and ask them to pay me these amounts. So I will ask another company to buy this debt altogether. Okay, this is the concept of debt factoring. Okay, يعني أنا حبيع الريسيفبلز اللي عنا نحن we own them. It's a part of our assets. Okay, so I will take this part and just sell it to another company وخلي الother company هي اللي تلاحق الزباين عشان يدفعوا. This is what debt factoring means. Okay, so there are businesses specifically to buy these receivables. لأنه تخصصهم they are experts in يعني following up with customers and asking them to pay what they need to pay. Okay, so here we have an example. Company ABC has average trade receivables of £200,000 and annual sales of £2.4 million. Okay, so this is the receivables. How much on average always I need to collect from the customers? It's 200,000 on average all the time. So it's considering the use of factoring, given that this would result in a reduction in credit control costs of 50,000 per year. Okay, so what is the advantage of factoring? It's asking somebody else, يعني it's outsourcing this activity to somebody else. They will do it for you, and يعني in return you will save money and time for not doing that. The factoring house charges a fee of 1.5% of sales. Okay, طبعا they will do it for a fee, not for free. They will charge you 1.5% of sales, which is this amount, the 2.4 million. It will provide an advance to company ABC of 85% of its receivables, which is 85% of this 200,000. Okay, and it will charge interest on this advance of 7% per year. Okay, of course they have their own charges. They want to make money also, this other business. Assess whether it's financially beneficial for company ABC to enter into this factoring arrangement. So what do we do here? It's a game of numbers right now. Okay, the numbers say that this is how much you have to pay for the company to outsource this activity to the company, plus the interest. Okay, so they said 1.5% of sales, and also they will charge you 7% interest on this amount. So your total cost will be 47,900. Okay, but your real cost is 50,000. All right, so actually you will be saving money. Instead of paying 50,000 every year, you are going to be paying 47,900. So there is 2,000 saving every year. So we will recommend that company ABC proceeds with the factoring. It's a good idea because it's a saving. Okay, If this amount was bigger than 50,000, then it wouldn't be a good idea. You will not be making any savings, but you will be paying more every year. Okay, so far we have covered 2 points. We covered working capital and we covered debt factoring. Okay, now we are going to cover the bank overdraft and bank facility finance. Okay, just like one of you answered, if you need money to finance the business, you go to the bank. Okay, so this is the third point, is taking a loan from the bank. Okay, what does an overdraft mean? An overdraft are simply bank current accounts that have a negative balance. يعني ممكن يكون عندك account بالبنك تسحب منه لحد ما يصير زيرو. اوكي، في بعض البنوك بيسمحوا لك تفضل تسحب لحتى يصير negative. This means borrowing money from the bank. حتى لو انت صرت بالسالب بالنيجاتيف, it means an overdraft. So we are borrowing money from the bank. Okay, so of course, accessing this form of finance requires negotiation with the bank, having some terms of how much maximum you can overdraft, the interest that will be charged, whether the fees are charged when the overdraft are utilized. Of course, each bank has different rules, each bank has different charges to its customers and different offers. Okay, but in general, the bank overdraft means you are getting a loan from the bank. You are borrowing the bank's money. The bank facility finance can be used to draw on a larger pool of funds. So basically, you go to the bank and you tell the bank, I want a loan. Okay, so when you buy a house, when you buy a car, you go to the bank, or even they can give you a personal loan. Okay, you tell them, I need a loan, and it will be separate from your bank account. It's something else. Okay, so this is the difference between the bank facility finance and the overdraft. Overdraft, it's from your account becomes negative, but the bank facility finance is a loan by itself. Okay, so it's a long-term loan. Number 4 is the lease finance. Leasing is another widely used form of finance for organizations. Leasing is where an organization arranges for a bank to acquire an asset that it needs and then leases it from the bank for a defined term. Okay, I'm sure you have all heard of the lease. When you buy a car, you can lease a car. يعني somebody else buys the car and you rent. The lease is a form of rent, and you rent the car from them, okay, until you don't want to use the car anymore. The car will be sold and the proceeds will go to the owner. By this time, you would have paid all the fees to the bank. Okay, يعني بيكون عندكم monthly payment. Leasing is attractive to both lessors and lessees for various reasons. It's a good way for both. يعني if I want to lease a car, it's good for me because if I don't have money, this is my only option. It's a good way for me to use a car without owning it. Okay. And also for the bank, it's good because it brings profit to the bank by charging, of course, interest and extra charges to the person who wants to use the car. Number 5 is equity finance. Both public and private incorporated companies can issue shares in order to finance their operations. Equity finance is when the shares of the business are sold to other people, other individuals, okay? So for example, today, if I go online and I buy a Microsoft stock or a Microsoft share, I become a shareholder in Microsoft, okay? By buying this share, my money is being used by Microsoft to maybe expand, maybe enhance the business. This is how Microsoft was able to become that big, okay? Because they raised money from the public in this case, okay? So this is what we call equity finance. You are selling the equity of the business in return of finance, okay? So you could have ordinary shares or preference shares. Of course, if you want to go deeper into finance, you need to understand the difference between buying ordinary shares and being a preferred shareholder. The difference in the two are that some of them, one of them is entitled to vote when it comes to voting on the decisions of the business, and the other one is not entitled to vote. All right, so shares have a nominal value as well as a market value. So today, the Microsoft share has a market value. It's very easy to know the market value. You just put on Google, what is the price of Microsoft share? Okay, and it will show you directly what's the market value of the Microsoft share. The nominal value is the real value of the stock. What do we mean by real value here? It's the real value of Microsoft, taking into consideration all of its assets and minus all of its liabilities, and then you divide it by the number of shares. Okay, this way you get the nominal value of a certain company. Okay, is it clear this point? A couple of years ago, the shares of Aramco were sold, right? Only 5% of the equity of Aramco was sold to shareholders. This was made to collect money because the money was needed to proceed with other projects, to enhance, and of course, to create value using this money. Okay, remember what happened with Aramco 2 years back? This is called equity finance. Number 6 is venture capital and private equity. The word venture capital is also issuing shares, but for big investors. Okay, these are venture capital companies. They are suppliers of private equity finance to new or recently formed companies. So, you know, in this world, in the finance world, we have rich individuals who have a lot of money. They want to invest. All right. And we have companies who are looking for money to use for their ideas, to use for their businesses. So the job of this venture, the job is to match these two, the venture capitalists with the companies who need financing. Okay, so this is not like Microsoft where it's a public, anyone can go and buy a share. No, this is more, it happens more private, and the investors become part of the equity, part of the business. They are entitled for part of the profit. So what is the benefit to companies? It's to that provide private equity finance is the prospect of higher returns from their investments. In this case, there is much higher return in your investor. Angel investors are a subset of venture capital investors, which we call them angels. Why do we call them angels? They invest in small companies that are innovative, they have new ideas at very early stages of their lifespan. So they are called angels, and they have high net worth individuals. These are very rich people who want to invest in new, creative, innovative businesses. Of course, they are taking a big risk, but in return of this risk, they could be making a very high return. Okay, so here we have the reasons why companies would use private equity as opposed to using a public offering of shares to raise finance. Okay, because sometimes the equity finance may simply not be available through the public route. Okay, not any company can go private like Microsoft. If you have a small coffee shop, you will not be able to raise finance by becoming a public company and selling your stocks on the New York Stock Exchange, right? You need to find maybe a private equity, a friend or a relative or somebody that you know who wants to invest in your business. This is called private equity. It could be faster and easier. Okay, raising private capital is faster than accessing the capital markets. Okay, and also the advantage is that by remaining private, the company is less exposed to the competitors, because when you are private, you don't have to share your balance sheets, your financial statements with other public entities, so your business remains more safe. Initial public offering, we call it IPO. As a company grows and establishes a track record of performance, a point may be reached where it needs more finance to support the development of the business. This is exactly what I said happened with Microsoft. Okay, يعني بيقولوا لكم بيطرحوا الأسهم للسوق. Okay, IPO is when they put their stocks to the public to be bought by the public. At this point, the company may go to the public equity market to raise the capital. What do we call it? It's called IPO, initial public offering. Okay, because this is when we first put the shares and we offer them to be purchased by the public on the market. Okay, do you have any questions?